If you don't know what a dividend is, but you want to learn about dividends right now, or you want to know what your best options are to get a dividend as early as right now without falling for clickbait, you've come to the right place. In this video, we will first explain to you what a dividend exactly is. Does it even make sense for you to invest in high dividend funds or stocks? We will also discuss 5 options to build a steady cash flow from dividend funds or stocks. Stay until the end of the video to see our summary. If our videos are helpful for you, please invest a second for subscribing to Ape Finance, our investor community for beginners to experts in personal finances, as this will go a long way to help you when investing your money. Now, let's get into the video. You may have heard of dividends somewhere, but do you really know what a dividend is? A dividend is the distribution of a company's earnings to its shareholders and is determined by its board of directors, or simply, a dividend is the amount of money paid by a company to its shareholders. Dividends are often distributed quarterly or on a yearly basis and will be paid out normally as cash. But there are also exotic dividends, like the legendary chocolate briefcase you will get every year if you hold shares from Lindt & Sprüngli, or up to 20% price reduction for car rentals if you hold at least one share of the Sixt rental company. Through dividend investing, you get the opportunity to participate in a company's growth while also getting your share from the profit the company makes. But does it make sense for you to invest in stocks that pay out a dividend? Companies that pay out a dividend to their shareholders are typically really stable, so you don't need to worry too much when investing in these companies. Most big companies like Coca-Cola and Apple pay dividends to their investors. There are many good reasons for you to invest in dividend stocks. One of the many upsides to investing in dividend stocks is that you get to enjoy the profit the company has made over the past year directly. The bad side when it comes to investing in stocks and funds without a dividend focus is that most small companies do not pay out dividends and will invest all the money they made in their newest ideas to grow the company and give you the return of higher stock prices alone. If you check out the linked video we did about Meta, you will realize that this will not pay out every time. But looking at this situation from a statistical viewpoint, small companies outperform big ones in the long run. This is because they have higher growth potential and end up offering better returns in the long term. But due to their small nature, and with the fact that they do not have huge market capitalization, they tend to be blown away by slight negative changes in the sector. With all this said, if you like to see a steady but fast-growing cash flow as we do, dividend investing is a really nice thing to try out, but it can harm your performance compared to a portfolio without a dividend focus. Dividends can also, depending on the country you live in, be taxed higher than capital gains. Also, it is important to not focus only on the yearly dividend yield, as the business should have enough cash to pay it and not make a mistake by paying out more than they earn. Now, let's check your best options to get additional paychecks. Number 1. High dividend ETFs. The main perks of ETF investing are that they are highly tax efficient, they involve low expense ratios, and they are also diversified. The easiest thing to do if you want more cash flow without experiencing any headaches is to just invest in a high dividend or high yield option of any ETF worldwide, as most of them pay dividends every 3 months. There are many high-paying ETFs to invest in, some of which include the Vanguard 500 Index Fund with net assets of $753 billion, the Invesco QQQ Trust with net assets of $164 billion, and Vanguard Total Stock Market ETF with net assets of $1.17 trillion. If you want dividends every month, you can search for a fund that pays dividends every month or buy a combination of different ones. This is where the diversity of ETFs comes into play. The dividends can go up to 4% per year, while some go even higher. Exchange-traded funds are low-risk investments and are a very good way to build a diversified portfolio. So, if you are a beginner in dividend investing, you should definitely take a shot at ETFs. But always remember to keep everything as simple as possible. Let's go into real estate now, where your yields can be even higher. Number 2. Real Estate Investment Trusts, REIT. An REIT, or Real Estate Investment Trust, is a type of company that is centered around publicly traded real estate property, including office buildings, hotels, warehouses, and retail centers. One of the best-known REITs that can be found in the market is a company called Realty Income. This company is famous for being the dividend company and has an excellent track record with a compound average annual total return of 15.1% since 1994. Also, they pay dividends to you every month. REITs are required to pay you, as a shareholder, a minimum of 90% of their earnings. As the name implies here, we are investing in professional real estate companies that own and manage different real estate properties depending on the business model. If the involved risk of being dependent on one company is too big for you, there are also ETFs consisting of many different real estate investment trust companies. Some examples are the Goldman Sachs Future Real Estate and Infrastructure Equity ETF, the Xtrackers International Real Estate ETF, and the Invesco Active US Real Estate ETF. Also, you can invest in the biggest REIT fund available in your country. Many of them also will pay you a monthly dividend, but you need to know that the value of this part of your portfolio will depend on the housing market as well. So be careful because of how unstable the housing market can be. Number 3. Preferred stocks. Preferred stocks are stocks of normal companies but with higher dividends, which are typically around the 5% per year range. Depending on the company, they can also be traded on stock exchanges publicly. You also get more rights in case of liquidation compared to other stocks. Preferred stocks can be used as a good source of fixed income because of these reasons, but the thing is that, with a preferred stock, you cannot vote on issues as you would be able to with the common stock. There are also funds of company preferred stocks, but be careful, because if you compare the performance to a normal ETF, the highest yield does not help you when the performance overall is miserable. Number 4. Royalty trusts. With royalty trusts, you can participate in rights to produce energy. Royalty trust companies are companies usually involved in energy production or mining. These companies are not taxed at the corporate level on the condition that their shareholders are paid a very high percentage of their profits. Also, here you have the option to participate in various funds and get the option to be paid out over 10% per year in dividends. However, in this type of investing, you should take note of the risks of the energy sector, as these cash flows depend on production levels and changes in commodity prices. This can be very risky, as you will see if you check out the video we did on the energy crisis in Europe. But what is investment without risk? And moreover, these investments have very high yields, since the companies are obliged to pay their shareholders very high dividends. Most of these companies offer interest rates above 10%. Therefore, in this world of low interest rates, it isn't surprising that royalty trusts are gaining popularity so quickly. There are more options to participate in high dividend investing, for example, bonds, but we will address bonds in a separate video. Make sure to subscribe for that one though. We all love dividends, and they can keep you motivated for many years to stay with investing because they make you feel good and also add some flesh to your bank account. But you always need to consider whether you prefer a higher yield of 4% payouts of the invested value per year to possibly have a lower return in overall growth. Also, depending on the country you find yourself in, dividend taxes might be higher than those on stock price growth. There is also the option to go for a growth portfolio when you're young and then shift to higher dividends when you're older, and therefore need more cash flow to compensate for all the time you spend relaxing and not working. So, just as it is with many things in life, do not depend on one bet. And if you're new to investing with all its possibilities, just go first with a normal, broad index fund and don't worry too much about optimizing your dividend return. Learn how to start investing in the first place by clicking on the linked video. With all that said, make sure you subscribe to Ape Finance, and we will see you in the next one.